Hello, welcome back. I'm Dr. J, and this week's Time is Money, a special edition brought to you by our sister company TradeMonster.com and MSN Money. So let's get right to it, folks, because time is money. Next week we've got some earnings that I think are pretty interesting coming our way, starting off on Tuesday with Adobe. Now, if it's anything to do with web publishing, that's Adobe's wheelhouse. And the stock has just been decimated. The stock's down from $46 to $16 a share in the last year. It's made a little bit of a rebound. A recovery has carried it to $18.50. So as you can see, it's a far cry from those $46 levels. But with earnings Tuesday next week, we look at the possibility of going in here and doing a put vertical. That is, we go in there and we sell the at the money put and we buy a put further out of the money against it. Thereby, it's a limited risk trade because we keep the money if the stock rallies above the put strike that we've sold, and if it does go against us, if the stock goes to the downside, well, both sides, the put that we've sold as well as the put underneath it, go to the money. That means that spread could go to the differential between those two strikes. The spread I'm talking about is the April 22.50 put spread. So I'm looking for this thing to rally above 22 by April expiration. So if you were to get in there and sell that spread right now, you could get $2 for that spread. Think about it. Your risk is 50 cents because the differential between those strikes, 22.50 and 20, is of course $2.50. If you're collecting $2 for that, your total risk is 50 cents. So you got to like the risk reward there, folks. You could of course go out and buy that call spread if you didn't want to sell a put spread. By the way, that call spread would trade for that same 50 cents because that's put call parity. Let's go ahead to the next day and take a look at Wednesday. General Mills, G like Gary, I like India, S like Sierra, GIS. What do they do? I think you know. This is a cereal maker, folks, and their shares have also been hit pretty good. Consumer may be tempted to cutting back from the name brand products and maybe going towards a generic at some of the off-brand grocery stores. That does happen. So that's been eating into them. They haven't been able to raise prices as much either, and so the growth not there. So it's understandable why shares are down from, let me see, 72 to 49. Now right now they're at 52.50. So that 52-week range that I described right there, 72 on the high, down to basically 50 bucks. Now at 52.50 means this stock is still way on its backside hard, but they do make money still. So what am I doing? I'm doing a call vertical spread. I'm buying one call, selling a call above it. So I looked at doing the April 50 against the April 55. Taking a look at that, I believe it gives you a great risk reward. The stock's at 52.50, so if we see a rally of $2.50, that means that the 50s we bought would trade for $5, and those 55s we sold, if they finish in the money, would trade for whatever amount they are in the money. If we just rally up to 55, then those go out worthless. We make more than 100% on our money on a $2.50 move in General Mills. So that's why I like the odds of that one. Also on Wednesday, take a look, Nike. It's one of the hot stocks going into the Olympics last year. We all know it, and we know why. Because Nike, that's what they do, athletic gear. Well, and not just shoes. Take a look at where Nike is. In the last week, this stock has rallied from 38 to 45. So let's call it a nice $7 rally going into earnings. Maybe a little overdone, or at least maybe the stock stabilizes in this area. That's my thinking. So what am I doing to take advantage of it? We're doing a straddle. Straddles look like this if you sell them, folks. It looks like an inverted V. This is if I buy a straddle. This is if I sell a straddle. So So if I own the stock here and I sell the straddle, I'm selling the at-the-money call, at-the-money put. How much money am I collecting? Oh, let me see, $5.65 for a stock that's right here trading at 45 bucks, that at-the-money 45 straddle. That means I'm protected down through 40 to the downside, and I'm good up through 50 to the upside. So either side, $5 above or below that strike, the 45 that I've sold, means that I have a profitable trade. I think it basically comes out with earnings, maybe even they hit it, but then it stabilizes here in the mid 40s, and I wring money out of this trade pretty quick. Lastly, I'm going to leave you with FedEx, FDX, Federal Express, you know, package delivery and all the rest. Stock was $100 in the past year. Where is it right now? Trading basically at $37.75. Just $3 off the multi-year lows is where FedEx is right now. So what do I want to do here? I'm going to sell a put and make it a cash secured put sale. Just bang, put them in your face. You got them. I'm going to sell the April 35 puts to open, and if I sell those puts and collect $2 for those puts, I keep that $2 if the stock stays above 35. It's at 37.75, folks. So I like the odds. The stock could fall by over $2 and these puts are still worthless. By the way, if they do put stock to me at 35 and have collected $2 for the put, that means I'm effectively long Federal Express at 33. That's that 35 strike minus the $2 that I collect means I'm being put stock effectively at 33. A stock right now that's $37.75. I'm Dr. J from OptionMonster.com. Our sister company Trade Monster says, why not open a paper trading account over there? You don't even have to fund the account to do it. You open a paper trading account, folks, you just fill out the paperwork over there online and don't even fund the account, and you can paper trade, which means that their systems at Trade Monster will track tick for tick throughout the day the profitability of those trades without committing your capital. That's the way to learn over at TradeMonster.com. Also, since we're dealing with MSN Money, we want to thank them for putting us up. After all, time is money. I'm Dr. J.